Yeah, I think it's consolidating. It makes sense. Bitcoin is responding to global liquidity, which is moving up, and I think anticipating a dovish Fed next year, so that's a tailwind for Bitcoin. But, Bitwise has a great stat. 95% of all Bitcoin's been mined, but 95% of the world doesn't own Bitcoin. So I just think that there's still a huge demand versus supply imbalance, meaning there's a lot more potential buyers of Bitcoin over the next 10 years. And so I think there's a lot of upside into year end.
Into your 150 target.
Yeah, 150, maybe 200, even 250 this year.
Tom Lee opens by reaffirming his long-standing call for the S&P 500 to reach 6,600 by the end of the year. Despite the April market downturn, where investor sentiment was shattered and many feared an Armageddon-like collapse, Lee and his team at Fundstrat never wavered from this target. He believes that April marked the bottom and now sees a stronger business environment than even in February, supporting a more confident path to that 6,600 milestone.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yes, I think, when at the April lows, we thought we could make a move back to 5,500.
Right, we're at 5,900 on the S&P.
That's right. But our full year target was 6,600, so I think that's still a reasonable expectation.
You never changed that.
We haven't changed it.
Never did. Even on April, week of April 2nd or 7th or 2nd, you didn't change it.
No, it felt very shaky because that would have been, a couple 1,000-point move needed. But now that I look at 2026, I think businesses are in better shape now than they were in February. So I think making 6,600 actually seems more achievable today than it did in February.
And you think a bull market started April 7th, or a new bull market started April 7th? In everything, because the NASDAQ already, if you just use 20% to measure what is an actual bull market, people think we need a broader indicator, a broader reason to call something a bull. But at this point, I think the S&P is also in a bull market.
Yeah, I think that the waterfall decline into the April lows was such a reset of sentiment. People talked about Armageddon, and we saw some of the most rapid deleveraging of hedge funds ever, and a collapse in investor sentiment, and a huge change in positioning. So those are, I think, things that look like what happens in a bear market. And the ISM has never broken above 50 in a sustained way. Market tops usually need an ISM to stay above 50 for a period of time. So I think we're at the start of a bull market. And as I look at 2026, I think housing could actually be a big lever to pull next year.
What do you think of the recent inflation data? And is it real? Is it lasting? Is it going to turn around and head back up because of tariffs? Were you surprised at those numbers on the last couple of Friday and then a couple weeks before then?
Well, as you know, the inflation for the last month actually has defied expectations because a lot of people said these shortages would cause a spike, and instead core inflation actually has been trending lower. But to me, inflation was really a story about housing and auto insurance. Those were powering inflation for the last 2 years. Combined, that's 75% of the rise in inflation. Housing is actually now subtracting from inflation month over month. And I think in some ways, on a real-time basis, that tells me I don't think core inflation is actually going to be turning up, even if goods prices go up.
You don't?
No, I kind of agree with Waller's comments.
You do agree with Waller's comments?
Yeah.
So you're anticipating cuts, several cuts this year?
Well, I think that if core inflation behaves, then we are in a really tight real rate environment, right? 4.5% monetary policy and 2.5% or 2% core inflation. There's a need to actually reduce interest rates.
Do you, Tom, at this point think that interest rates, because it doesn't matter whether we reduce or not, would the long end go up if they reduce the short end because of $37 trillion or this bill that's the big, beautiful bill? Are there worrisome things on the horizon other than inflation, current inflation?
Well, yeah, the U.S. is on an unsustainable sort of path for deficits, but Japan's actually had higher rates, and their interest rates have been behaving for a long time. I mean, not recently. So I think the long end is essentially unpredictable. When investors worry about it rising too dramatically, then I think that's when the bond market can have some influence on both the Fed and the Treasury. But I think at these levels, it's not that alarming.
What's Bitcoin? What is it moving with? Just risk assets at this point? It got back to an all-time high, which you were forecasting as well. But now I think, what are we, 104 this morning? So it's pulled back.
Yeah, I think it's consolidating. It makes sense. Bitcoin is responding to global liquidity, which is moving up, and I think anticipating a dovish Fed next year, so that's a tailwind for Bitcoin. But, Bitwise has a great stat. 95% of all Bitcoin's been mined, but 95% of the world doesn't own Bitcoin. So I just think that there's still a huge demand versus supply imbalance, meaning there's a lot more potential buyers of Bitcoin over the next 10 years. And so I think there's a lot of upside into year end.
Into your 150 target.
150, maybe 200, even 250 this year.
What? 150 to 200 to even 250. And what's you don't have a terminal price on that, do you?
Well, it's I think at a minimum it should have the same network value as gold. Mm-hmm. And if you look at above ground gold, it's probably 23 trillion. So that would be 1.2 million for Bitcoin. But I think Bitcoin is more valuable than gold. So, gold, Bitcoin could be 2 million, 3 million long term. Even higher.
Okay. Thank you. And we're talking years, obviously, but 95% mined. I don't think the last one is mined till 2150 or something.
Yeah.
It's getting harder and harder.
Yeah. Depending on what decimal you want to use, it's probably 2040 or something. But yeah, but it's, if you're having something forever, it'll always.
So what's your terminal value?
That's what we just
said.
The final. He said 2.5 million.
2.5 million at the end.
Yeah.
Or maybe, maybe higher.
Or maybe even higher.
I didn't appreciate that point.
Tom Lee also offers a scathing critique of Keynesian economics, which has long dominated central bank policy. He argues that Keynesians prioritize growth over efficiency, focusing on inflating GDP numbers rather than improving economic output per unit of input. By measuring the economy through nominal metrics like GDP, policymakers justify endless money printing, all in the name of avoiding the bogeyman of a deflationary depression.
When you have zero interest rate policy, people can borrow for no cost and then buy things to yield return. Well, they do. And so what you see is it pushes the price of all those things up a lot. And so stocks took off, and housing prices again kind of took off, and bonds took off, and so on and so forth. And so, the prices are not real; they're fake because the cost of the money was fake. And of course they started trying to raise rates in 2015, but they didn't get too far. And in 2019 they had to pivot. And then of course COVID came along, and they had to took rates back down to zero again for a couple of years, 3 years. It's a real problem. The Federal Reserve and all the central banks, but principally the Federal Reserve, because they're the leader, they've really broken the monetary system. I think the title of Lynn Alden's book, Broken Money, it's a great title because that really is what's going on. The monetary system is broken. Sadly, most people don't understand that. And that was my writing this book, and the way I wrote it and the stories and I told it was to try to help everyday people to understand what's going on. That's the issue. Yeah, well, it's just because, the Keynesians kind of got control of the economic system, and they've controlled the narrative. And the Keynesian model says growth is the thing we should worry about, when in reality what we should worry about is efficiency. And they measure growth by, the top line gets bigger, and one way to make the top line bigger is to push prices up so you get growth. So they're kind of focusing on the wrong measurement metric, and whenever you measure, what you measure for is what you get. They've even gotten to the point, the Federal Reserve's original charter said not original charter, but the charter they amended it to in 78 said stable prices and full employment. That was what they call their dual mandate. I don't know about you, but I think stable in prices would mean zero inflation. But they've defined it, and they've even said it. They've got papers out that defend it. They've said, well, no, we have to have 2%. A little bit of inflation is good. And their theory is that if you don't have a little bit of inflation, we risk falling back into the great, deflationary depression. And they use the depression as a catch-all to cite the fear of that and say, we can't have that happen. We've got to print money. We've got to keep the system growing, or else we're going to have a depression. And that's just not true. It's just completely not true. But, it's a sophisticated argument, and one has to be sophisticated and look at the history, and the book does, to counter the argument and say, no, you guys are wrong about this. You're just plain wrong. I mean, there were times, if you look at the United States from 1789 to 1913, other than the wars, there was very, very little inflation. And the economy did quite well. I mean, the economy grew very quickly, and, living standards, think about how much the living standards improved during that time frame. And that was all on a gold standard. And yet, these Keynesians, these modern day, monetary wizards, they demonize the gold standard as being this evil thing that caused the depression, which it didn't, which is untrue. And the reason, I guess the thing that people need to come to understand, and I tried to point this out in the book, the reason they do this is that it serves their interests. They want to be, it helps government, it helps the Federal Reserve, it helps the financial players. There's a segment of society that actually knows how to benefit from inflation. They want inflation. Inflation's good for them. They get richer through inflation. How do they do that? They're able to borrow cheaply and invest in higher yielding assets. And so, the combination of those things make them richer, the sophisticated people at the top, but they leave all the rest of us paying for higher grocery prices. And so, it's incredibly unfair. One of my most depressing charts in the book is near the beginning, where it shows the percentage of the wealth in the United States owned by the top 1%. It's like 92% of the wealth. It's nuts. The middle class has just been eaten alive, and yet the rich keep getting richer. So, in my opinion, that would not happen if we were on a sound money standard, gold standard or Bitcoin standard.
One of the most alarming statistics Lee highlights is the wealth concentration in the U.S., with 92% of the country's wealth now controlled by the top 1%. This is a direct consequence, he believes, of the broken fiat money system, and it's why he advocates so strongly for a return to sound money principles, whether that's gold or more ideally Bitcoin. Please like and subscribe.